Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Friday, and thank God it's Friday, everybody. Hope you guys have a great plans for the upcoming weekend. And it's February 10th, so we'll just jump right on into it. And again, this has been kind of a late week this week, so first item to note is trade deficit. Again, this is not going to affect the bond market as much. So back in November, we had a negative $47 billion deficit, and we figured it would go up 48.5 billion, and it did. It actually went a little bit more than expectations or the forecast. So unfortunately, we just keep getting deeper. This might have been a result as the dollar kind of gained strength over the holiday season a little bit, so that may have helped. Pushed us over a little bit as our cost of goods become more expensive when we sell overseas. So let's jump over the next item here. We got the consumer sentiment. This is kind of an important indicator as to what we want to look at because this is how the people are feeling. And if they're feeling good, that means they'll be spending money and hopefully get the economy moving. If they're feeling bad, they're going to not spend money and not go out. And of course, then we have a retraction. That's how we kind of start going into a recession. So for January, we're at 75. We're looking to kind of climb upwards in February here, and actually drop down to 72.5. So this is kind of important. We will need to keep an eye on this as to see where we head with this. Hopefully, it don't go down much further than this. Hopefully, we'll see this start climbing up. Hopefully, in the near future. So we'll jump over to the headline news. And basically, the stock market's down. A lot of the stock traders are just kind of cashing in and taking their gains right now. But a lot of it has to do with apparently there's some talks broke down in Greece's austerity measure agreement. Apparently they're not willing to cut as much as money as what's the IMF and the European community is basically demanding of them if they want to give them the money for the bailout in March. So apparently they're at a stalemate at the moment. They're still working on it, but it took a step backwards as of right now. So we'll see how this is affecting the bond market and take a look here and where interest rates are moving. The bond market's about where actually we would have had a rise. The reason why you're seeing it down is because, as you can see on the graph there, we have a bond rollover. It's worth about 24 basis points. That has no bearing on pricing. It's simply that they cut the coupon, and that month of mortgages gets packed up, gets sold on Wall Street, and then they begin a new one. So this is just a rollover price. It's down 24 basis points. The second arrow you see with the purple, that's where it would normally be. So in this case, so that's where the pricing would kind of start on a normal basis. So, but again, the pricing is the same. Don't worry about it. So we're down, and so pricing is about where we left off. As we saw, we had kind of a big drop yesterday. We even touched the floor yesterday. But again, we're still underneath the 10-day moving average. Maybe this will give us a chance to start a rally and go upwards a little bit, especially as we get closer to the possible Greek default. If they can't come to terms, the market may panic a little bit more, and more money might go into the bonds. So that could help us out there. So right now, interest rates are about the same as they were yesterday. All right, folks, you guys have a wonderful weekend. I'll catch you guys on Monday. If you guys are on my site, please subscribe and get your free updates. Have a wonderful day again.